So we are going live now. Yeah. So hey guys, like for those who join, like can you let me know like whether my sound is loud and clear? If yes, please type one. You know, all right? Okay, sounds clear. Oh, hi Rosum. Hi, hi. Good evening. Good evening. Hi, hi, hi. Clear, Vivian. Hi, Vivian. Yeah. Oh, relaxing. Hi, hi, hi. Good to see you again, bro. Good to see you again. How's everyone? Like the market has been gap ups, I hope you guys they actually is like, capture some of the profit or maybe like uh collected some premiums. Hi Scorpio. Hi, hi. How's it going? How's it going? Yeah. So we are going to start at 9 o'clock. So like we will have like we'll have some little chit chat before we getting started because we have to wait for the rest to actually join these sessions. Nice to be back to listen to you. Oh, thank you, thank you, thank you. I didn't know that I already have a fans. All right. So yeah, like how's the previous sections like? Did you guys actually just like go through it and then it's like understanding how is the options going to be working around? Like the strike price or all those kind of things, buyer and the seller. Like from the phase one, like the phase one that I did for you guys. Like I hope you guys have a full understanding is that whole structure, whole mechanisms of the options. You know, just wondering, like just asking a few questions, like maybe like is there anyone's like tried out the options already? I'm just curious. So after first chapter one and chapter two, then you get the ideas of the options, like new to option, hoping to learn more from everyone here. Yeah, 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 yeah. Sure, sure, sure. I'm also learning from you guys. Like try a single options. Okay, is it a cell leg or long legs? Like, and does it works for you? Like, is the direction works in your favor? Oh, hi, Nyonya. Hi, hi, hi. And Win. Yeah, yeah. Yeah, Win is here as well. Usually sell to collect premium. Yeah, nice, nice, nice. You know, but be mindful about the risk that I have mentioned in the chapter two. Like if you want to collect premiums in a safer ways, then there will be more sections to come to actually teach you how to collecting the premiums in a much more safer way and is in a much more higher probability, I would say. You know, yeah, because risk is the first things that we actually have to like address, right? Whenever before we enter into a trade, so when to exit and then how much we can lose. Budgeting is always important as we as we have discussed on the chapter two before, right? So like you can see roughly a lot of people is like why we do a lot of research because we just simply want to avoid those kind of the unknown risks, you know. Hi Williams. Hi, hi, hi. Hi Williams. 666. Things are liu liu liu, right? Okay. So we have 1 minute to go. It's like we'll wait the rest to actually join this section so that we can get started after at 9 o'clock. Did you guys have your dinner or yeah, yeah, yeah. Who's here registered their interest for the physical option playbook? Yeah. Just wondering. Yeah. So yeah, it's 9 o'clock now. So shall we start? If let's say you guys are ready, yes, please type one. Okay. If you guys are ready, please type one. We are ready to go. No. All right. I see the lot. One incoming. Yo, thanks. Thank you guys for the response. Yeah, appreciate your time to actually like still spending, it's a late night, so we still are here talking about the markets and then learning some options. Thanks for you guys for actually joining. So let's get started. So we before that, of course, we definitely will have some disclaimers, right? Of course, like the whole sections, any ticker symbols that I have mentioned in these sections, like remember, it's all for education purpose only. Okay, please do read the disclaimer well, so that you guys are aware of what's the underlying risk, what is the things that to be expect, and then the P&L risk is for hypothesis calculation, those kind of things. So take notes that okay, it's all for education purpose only. So like during the phase one, the chapter two, we have learned that there will be two sides of the tradings, right? There will be a buyer and the seller. And then we also knows that like in the chapter nine, we cover up the buyer side, like you having the rights to actually buy or sell. And then we also know that we have the what? We have what? We have seller, right? We have seller to actually help us to navigate those kind of the risk. So sorry, help us to collect the premium, and then we have the obligation to get assigned. Depends on which kind of the options we are in. And then in these sections, that's during the chapter two, we also covers that there will be a rights and obligations. Like for buyers, like we also having the rights to actually buy the underlyings, and then for the seller, we have the obligations to sell the underlyings. And then for the put side, we have the buyer having the rights to actually sell the underlyings. We also have the seller to actually has the obligation to buy the underlyings. Okay, we have to make it very clear. Okay, so in today's sections, right? In today's sections, we are going to cover a lot on this part, the seller on the for the call options. Okay, the seller call options. And then we are going to cover a lot on the obligation side. Okay, on the obligation side, which is selling the underlines. Okay, selling the underlines. You guys still remembers that whether the seller having or the buyer having the limited risk or the unlimited risk? Do you guys still remember? Just a quick questions like just a very quick questions like if you are the buyer, do you have unlimited risk or limited risk? If you are seller, do you have unlimited risk or limited risk? Okay, can anyone understand me? Because this is very important, like sell unlimited risk, yes, yes, yes. Limited risk for buyer, exactly. Okay, so there will be limited risk for the buyers, okay, and the unlimited risk for the seller. And then today we are going to cover on the call option side, okay? And then remembers like the call options, basically you are what? You are this fella, you are seller. Basically you are collecting the $10 ticket, and then you are obligated to sell this fella $150 for the ticket. Remember the story like during the chapter two, okay? And if the price stay low, nobody's want to buy, you just keep the $10 for and doing absolutely nothing, right? For example, like if let's say the concert cancel, the $10 you just collected. You don't have to do anything. You just collect the premium just like that. But if let's say the concert demand spike, it went up to like 400. So you die also have to sell sell the sell your ticket at $400 sell your ticket at $150, even though the price is now $400. Okay, this is basically the short call options. So in these sections, we are going to cover more on short call. Okay, you guys are right about it, about the risk profile. selling a call basically means that you're having an unlimited loss risk. Okay, unlimited risk because the stock price can go ups like crazy, like above like for example say above 100.05, then 100 it may be like went up to like 200, 300, 400. Okay, so that if let's say the price stay low, stay in within this range, you are making the profit. All right. Okay, so what we are going to solve now, what's the problem here? The problem here still remain at the upside, right? Still remain up from the upside. So some of the people might be asking why I'm still doing this kind of the things. If let's say I'm bearish, right? Why do I still need to short call? Okay. Some of you may wondering this, right? Okay. So in today's sections, I'm going to share why is that some people will be doing the short call. Okay. It's called, this strategy is called cover call. Cover call. Okay. Have you guys heard about cover call before? Like type 1 if you guys heard of it. Okay, type 1. Okay. Yeah, 1. Okay, there's 1. Yeah, cover call. Yeah, I believe like in today's, yeah, yes, cover call. Yeah. I think it's the first spread that you guys actually will be learning. Okay. Usually when you're getting into those kind of income things, right? You guys might be just like just getting started with the cover call. Okay. So how does the cover call works? So basically, this is you, okay, the one with the suit, with the handsome one. Okay, basically you're having the property, you own the property, you have the property. Okay, you already bought it like a few years before. Okay, so what you do now, you basically asking that collecting the premium, which is you renting out your property. Okay, you're renting out your property. So basically, the buyer of the call will be having the rights, right? Having the rights to actually lock at these prices, 300,000. So like me as a seller, and then I just collect the 1,000 premium. So what happened now? Like you rent out your houses, and then you collect the premium to agree sell it later at a profit. Okay, how does it work? So there will be only two scenarios. If the price of the property stay below 300,000, you basically just collected the whole 1,000 premium profit. Okay, it seems like the selling the cost, right? Okay, so if let's say let's look at another scenario. Okay, if let's say the price eventually from 300,000 went up to 400,000, the value spike up, so that the buyers will be keen to buy it, right? Because they actually can exercise their rights to buy at 300,000, while the market price is what? 400,000. So in this case, we are forced to what? We are forced to sell the property to the buyer at what price? We agree to sell at what price? 300,000, right? Okay, 300,000. Correct. So we are agreed to sell at 300,000, so that we have to sell to the buyer 300,000, even though the market price is 400,000. So here's the things. Is the premium still yours? This is the question. Is the premium still yours? Can anyone tell me? Yes, the premium is still yours. So you get to sell your property away at 300,000. You also collected the premium. This is the cover call, basically. Okay. So it same goes with the stock. Okay. why people, so you may wonder why I still need to knows like why I still need to sell at the 300,000 when like eventually it went up to 400,000, because you don't know. And then this is the price that you eventually happily to sell at. Okay, that you happily to sell at. Okay, so same goes with stocks, right? When you bought a stocks already, so most people already have you just buy and hold. Okay, you just buy and hold. So like traditional investors, right? They just buy a stock and then they stare at the chart and hoping the stock price goes up. Okay. So if let's say eventually the stock price stay flat like for 6 months or even 3 months or maybe it's like a year, their money is dead, right? If let's say they stay flat, for example, it's like you bought a stock like $100, it stay flat, you gain nothing. But you actually have but in this case you actually have a target prices. It just doesn't reach your target prices when you buy a stock. Okay, maybe like you bought you bought the shares at $100, your target price is like $120. You just wait for like 6 months to a year, and then the price that just doesn't hit your target prices, and you gain nothing, right? It's kind of frustrating, right? This kind of situation, you don't get paid for your patience. So what if we do? So how to solve this kind of the opportunity cost? So a lot of people, because they know that what is their target prices, they already know what is their target prices. So what they do something like this, like the cover call. Okay, what they do is like the strategic investor view every stock as a rental property. So even though the stock property value doesn't rise, they still get paid with this strategy. Okay, with this strategy. So in this case, even though the stock price went flat, we're still collecting premium. We're still collecting the premium. So in comparing with the traditional investor, if the stock went flat, you get nothing. You get nothing. Okay, so how does it work? Okay, how does it work? Remember the comic that I explained just now? Like you need to have a property first, right? Initially, you have a property. So basically, it's what you have a property. You are the seller. You have the property, which is if let's say we turn this analogy into the stock markets, basically you need to have what 100 shares with a sell call. Okay, 100 shares with a sell call. Okay, so what you do now? Remember, we have a buyer of the call, we have a seller of call. In this case, we have a property together with a sell call. So we actually sell one contracts to this buyer. The buyer buy the contracts. So what happens now? I collect the buyers pays me the premium. I get the what? The premium. I get the premium in this case. And then the buyer gets what? The rights to buy at the target prices. The rights to get at the target prices. Okay. So there will be only two possible scenarios or outcome. So the outcome A is that if the price doesn't reach the target, say for example, like you bought the houses like at 100,000, your target price is like 300,000. If let's say during this period, when you sell a call within this expiration, okay, within this expiration, if let's say the price doesn't rise above 300,000, you basically can keep your asset and also keep the income. Basically, you're just keeping the premium. Okay? So what if eventually the property price went up beyond 300,000? Okay. If let's say it went up beyond 300,000, say for example, it's like it went up to 350,000. It went up to 350,000. So what happened now? The buyer will be exercised, right? Because like the market price is now trading at 350,000, but you actually can buy at 300,000. So they will choose to what? They will choose to exercise. They will choose to exercise. So in this scenario, it becomes it will becomes this kind of an outcome. Outcome B. The price rise above the targets. The price rise above the target. Basically, what you need to remember when you're selling a call, your obligation is what? Can anyone tell me your obligation is what? Can anyone tell me? When you're selling a call, your obligation is what? To sell. Yes, to sell. Forced to sell. So I forced to sell the property at the 300,000. So I forced to sell the property at 300,000. So now the buyer happily to own the property at 300,000, and you also happily to sell your property at 300,000, even though the market price is trading at 350,000. Because initially you bought it at where? You bought it at where? Just now I mentioned you bought it at 100,000. Your target price, initial target price, your initial plan is to sell at 300,000. Okay, that's your plan. And then you achieve. You achieve your plan is complete already. Even no matter how high the price is at, your target is 300,000. So you happily sell your houses to them. So this is what we call the cover call. So like once you have the obligation, you just deliver obligation to actually sell your houses to the buyer. Then do you still have those kind of the unlimited risk on you when you sell a call? When you're selling a call, does it eliminate the unlimited risk? Can anyone tell me? Anyone can tell me? Yes, you eliminate the risk because you are covered. You have the property. You don't have to worry that your property you need to buy the property from the markets again and then to deliver to the buyer, because you actually have the property to deliver. You are not naked because you have stock. Okay, so this is one of the spread. Actually, you will have 100 shares with a selling a one call. It's called cover call. Okay, so who should consider this strategy? Okay, who should consider this strategy? Basically, this strategy is designed specifically for those income seeker as well, especially for those who have the underlying. Okay, so here's are the four things which generally they could consider this strategy. The first thing is the capital requirements. Is you have to understand that the capital requirement for this strategy is high. The capital requirement is high because you need to own what? 100 shares of the stock or ETF. You must already own 100 shares. You cannot own only like 10 shares, 50 shares, or 80 shares. You must own at least 100 shares in your portfolio. Why? Because one option contract is equivalent to 100 shares. So that in order for you to be covered, your portfolio need to have 100 shares. Okay? And then the risk profile, you basically is like low to moderate because you are using the asset to generate the extra cash. Okay, you have a long-term view. You already have a target prices. Okay, so that basically you just squeeze more out of your existing asset. That's all about it. Okay, and then also that you want to squeeze more returns, right? I mentioned already. You need to squeeze more return out of your existing asset like stock or ETF. And then you also need to intend to hold for like months or maybe for years. Okay, until your target has been met. Until your target has been met. Okay, so when to use the next part is that when to use this strategy. Okay, when to use this strategy. Okay, some people will say it's like, okay, when you remember when we talking about those four strategies like long call, long put, sell call, sell put. Okay, we all of them have different kind of the directions, right? Remember? Okay, all of them in different directions. If you're long a call, then your outlook you will be bullish. If you are long a put, then you are expecting the price goes down, so you are bearish. So in cover call, basically you expect what? Your outlook is what? You expect a slow and steady growth, and not a skyrocket to the moon. Okay, you're expecting a very slow growth. You don't expect like suddenly it just go parabolic, like $100 out of a sudden it went up to like $400 and $500. You want to expect the price grow slowly, not in a parabolic way. Or maybe you expecting the price will be went flat. It will be a very choppy market. It just went flat. So when the market bounce up or bounce down, basically you earn nothing, right? Remember, traditionally, if you just own the stock, you earn nothing. So if let's say you have a sell call here, as long as the price doesn't touch, go above the sell call strike, you are making the premium. Okay. And the third thing is when the implied volatility is high, because remember I told you guys that there in the options the premium have intrinsic value and extrinsic value. So extrinsic value consists of what? Implied volatility and time value. So when implied volatility is high, basically means that your premium is high. So you as a seller, you can collect more premium. So during the times when implied volatility is high, it's very good for the cover call the option seller to collect the more premium. Okay. So what to avoid? If let's say you are expecting something else, then what is the expectation to be avoid? If you avoid to use this strategy, if you think that the asset is going to crash, you may sell the asset right away. You may just sell the asset right away, not selling a call, because your thesis is not going higher or sideways, because you are expecting the price will crash. And then you may, if let's say you're having this kind of expectation, you should avoid using cover call. Okay, you should avoid using cover call. And then also, you also avoid, if you have the expectation that the price will went parabolic, okay, it just skyrocket to the moon. You should avoid using the cover call as well. Okay, because like this thesis works very well during if you're expecting the price grind slow in a slower paces or went sideways. Okay, so so far so good. Okay, the expectation. So I hope you guys to have a good expectations about this strategy. Okay, in options we have lots of the strategy cater to different kind of the outlooks. So in cover call, these are the outlooks that match with the core ideas of the cover call. Okay. let me see some question. Can you show me how to execute? Yes. Eventually, I will show you how to execute the whole process. Okay. So once we understand the outlook already, we are expecting is grind higher, which means we are a slow bull, and then or maybe we are expecting a choppy market. Then we are in this scenario we are good to go with the cover call if we have the underlying stock. So why this strategy works? Because you actually options will be decays, right? Remember I talked about like the time, as the time getting closer to the expirations, you're what? As time getting closer to the expiration, the premium will getting lesser because lower probabilities to getting in the money is already. This is the first thing. Options will decay. This is the first reason. The second reason is that most stocks actually spend a lot of time moving sideways and doing nothings. So basically, the cover cost is like turning that times into a real tangible profit. Okay. Then we also have the buffer. Okay, if say for example, if you buy a stock at $100 and you sell a $2 call option, and you collected the premiums already, right? So basically, your cost is what? Your cost being reduced. Okay, your cost being reduced already because you collected the $2 out of it. So your cost of $100 will be reduced as well. Okay. So how to trade these strategies? Okay. So you may wonder. So before we trading these kind of strategies, okay, we need to have a full understanding what is the thought process we need to be prepared before we entering into a trade. Because remember, in trading or in every single kind of the in your lifestyle, you also have you need to plan, right? You need to plan to do you need to plan you only to do something. Okay, you don't do before the plan. You have to plan, you only do. Okay, same goes with trading. Okay, the first setup is that what? The first step. This is the first step. First step is that you need to have 100 shares in your portfolio. We already mentioned that, right? Because like you must own the underlying to actually cover your obligation. If not, it will become a what? A naked call, which carries a unlimited risk. Okay. The first thing is you must own 100 shares in your portfolio. Okay. Some people might asking like, oh, what is the share I should choosing? Because this one is based on your research. Okay, based on your research, that you think that in the long run it will goes up. Okay, it's not going sideways. It will goes up. Your outlook will be going up, but not in a skyrocket way. And then if let's say those stock, it will be gradually going up. Usually will be what? You'll be those kind of the says like for example, like those fundamentally good stock under that, and then especially those undervalued one, you know, like those big cap stock. Yeah, those are the stock gradually will be rising. Okay. If you guys don't know how to research about this stock, you can start from like the top 10 or maybe top 20, top 30 S&P stock components. You can start from there. Okay, to do your research. Okay. So the second part is that you need to select the expiration. Remember that we already see, or if let's say we have 100 shares in our portfolio already, we need to sell a call, right? When we are selling a call, here's come the second question: which expiration I should choose, right? This is the questions you will be facing when you want to sell a call. So in these sections, in general view, then we will split into two things. Like one is the short durations, one is the standard duration. Okay, so the short durations will be around like 7 days to 14 days. Okay, some even shorter, like it can be like 3 to 4 days. Okay, the shorter the time it is that you sell, if you sell the call, your expiration is shorter within this kind of period. Usually, your upfront, the premium that you have collect will be lesser. Will be lesser. And then but your time decay will be very fast because like after 7 days or maybe after 4 days or 5 days, it will just expire, and then you collect your premium very fast. Okay, you're collecting your premiums very fast, and then you have to like frequently to sell a call. For example, every single 7 days, if let's say if your price doesn't goes above your strike price, every single 7 day cycle, you have to like keep on selling the call. The good things about the shorter duration is that you can keep on you have more flexible to choose your strike. Say for example, you bought $100 shares. Okay, $100 shares. You bought at $100. Your target price may be at like 110. Okay, $110. This is your target prices. So if let's say after within the 7 days, it spike up to $108, it's still below the strike price, right? If let's say I sell a call, they're 110 strike price. 110 strike price. Say for example, our target price is 110. We sell a strike price at 110. After 7 days, if let's say the price closed at 108, it's still below the strike price. So we collect the premium. So the next cycle, can we choose the higher strike? Can we choose like maybe my target price no longer 110. Maybe I want to set it 115. Can I do that? Can anyone tell me? Can I do that? Can I sell another higher strike after 7 days? Yes, I can. I can sell a higher strike as well. So if let's say you choose shorter duration, it gives you more flexibility. Okay, to actually adjusting the strike price. So if let's say your thesis is so strong that everybody the stock price within the 7 days spike up to 110, you just happily to sell your shares at 110. You just make the profit from the stock and the premium as well. That's it. But if let's say you are going for 30 to 45 days, the frequency will be lesser because like you have to wait a month. Like a year only have what, like 12 months. So that you only can collect 12 times premium. So it's less frequent. Again, because you are doing a cover call, you need to lock your what? You need to have your stock stay within 30 days. Okay. If let's say it's rise above, then that's a very different story. Okay. I think the market opened already. That's why my notification keep popping out. Okay. Okay. So hold on a second. Let me see like the notification. Okay. Hold on. Let me mute my sound. Okay. All right. So I mute my notification already because market open already. The notifications keep popping up. So if let's say, but the pros of the longer expiration is that you get higher premium because remember the longer expiration you have, the higher the premium because more probability the price will be moving in the monies, right? So that you can get higher premium. So it all depends on you whether you want a very frequent and active management or a less frequent, you collect more premiums. Okay. Why set this call before market open? Next time can do 8:30. Yeah. Because I running a bit late today. I got something else things to actually do by today. Sorry for the next time. I'll be just like set at 8 o'clock. Yeah, right. Sorry for that. So the next questions you might asking. Okay, once you have understand how is the expiration going to be choosing. Okay, so the second thing is what? Choosing a strike price, right? Okay. Strike price, you might be asking yourself, which strike price I'm going to choose? I'm not sure what strike price I'm going to choose. Okay. A lot of people have this kind of the misunderstandings. Like I just get the highest premium I can. without looking at the strike price. Okay, this is the very, very wrong method. Okay, the strike, because you already have the underlying bought, already bought, and then it's staying in your portfolio. Say, for example, it's like you bought it at $100. Okay, you actually don't sell $95 just to get more premiums, okay? Because it's in the money already. You see a lot more premium. You just sell it at this strike price. You don't want to do that because like basically if you're selling a $95 call, basically means that eventually after expiration, you bought it at $100, you have to sell it at $95. So basically you are losing the money just to get the premium. Okay? This is a lot of people make the first mistake. They just looking at the premium, then they just sell the highest premium they could. What is the premium should be choosing? There is a few methods. The first one is the chart pattern. If you are technicians, I believe like a lot, yes, always choose above $100 strike price because your cost is at where? $100. Then you should choose higher than $100 strike price. This is the first rule. The second, then how you can define your strike price? It can be like 110, 120, 130 strike. Okay. The higher it is, of course, the less premium you collect. The closer it is, the more premium you get. Okay. Later I'll show you how it works. The first method is that you can use, if let's say you are technicians. You see there is a resistance at maybe like 110 or maybe 105. Okay. So you can use this resistance level to become your strike price selling at, because like that's the resistance level and then that's your target as well. Okay. Your resistance can be your profit target as well. So because a lot of technicians, they will buy at the support, they sell at the resistance. So you can use your technical skill to identify where is the next resistance. So you can sell the strike price at that resistance level. This is the first method if you are technicians. But if you are fundamentals driven, okay, say for example, I think the stock that I bought at $100 is undervalued. I think at least this stock will be valued at 110. I will be selling my strike at 110 because of the fundamental valuation reason. This is the second reason why you're picking up that strike price. It always comes from idea, okay, not simply from premium. So that for those who are listening, you have to identify who you are. Are you a technician or are you a valuer? Okay. If let's say me myself, usually I will be just using the, because I'm a technician, I'll be just using some indicator or maybe some resistance to becomes my target prices. Valuations, because the valuation is kind of like a very long term, so that if let's say you are very long term driven, then is you can use this. So once you have all this set up ready, you just execute the trade. Remember what you already having now. You already have the shares in your portfolio. You already have the shares in your portfolio. And then now what you need to do, you already identify what expiration you need to get in. What is the strike price you need to get in? So what you do now, you sell to open one contract. Okay, you sell to open one call contracts because you only have 100 shares. So you just sell to one contract to open one contract to collect the premium. That's how it consider 100 share plus one sell call be equal to cover call. Some people they do like what? Like 100 shares, I have 100 shares at $100, I sell two calls so I can collect premium. No. Your second sell call will become naked. So you are not doing cover call. What you are doing, one cover call and one naked. So they don't make this kind of a mistake if you are if you are not aware of the risk. Okay. So when you sell to open, your call option failed, then your 100 shares will become your collateral. So it will lock up your 100 shares, become a cover call. So what you do, you just wait. You just wait. Okay? You just wait, the option expire worthless. If let's say the underlying prices or says the stock price stay below the strike your target prices, you just keep the premium. Then you just do it again and sell another call. And then what strike you want to set at is up to you, entirely up to you. Okay. But if let's say you are in the scenario B, okay, the price rise above the strike price. It rise above your target price already. You simply just sell your share at a higher prices and also keeping the premium. And then what you do, you just celebrate and you take your cash and you find a new opportunities. That's it. Okay? So let's getting into the example flow. How does it works? Okay. Why initially I say some of the capital efficiency, it will be reduce your cost, those kind of things. Okay. Let's see the single month scenario. Okay. Setup. This is a setup. I own 100 shares of Apple at $200. I own 100 shares of Apple at $200. So what I do now, I sell a 30 days of the expiration. My target price is, I think will be goes up to $210 strike price. So the premium for this call was trading at $2.50, which is I'm able to collect things $250. So with this setup, let's look at different scenario at the price at expiration. If the price eventually from $200 crash to $180, if you only have the stock, you don't do cover call, you will be losing $2,000. But if let's say you are doing a cover call, it crash, your premium could be your partial cushions. So you take 2,000 losses from your stock, but you collected $250. So it eventually your whole setup will be only losing 1,750. So in this case, comparing the cover call with the stock only, your cover calls win. Okay? Your cover calls win. But if let's say the stock stay flat, if you're only holding the stock, you gain nothing. Okay? 200, you bought it at 200, the stock at 200, you gain nothing. But after the expiration, it doesn't rise above your strike price, right? So you're still collecting your premium. But if the stock rise slightly, rise to $205, your stock is making money, right? Because you bought it at $200, now it's trading at $205. You are making $500. But does the price close above the strike price? No. So you collect another $250. So total you have $750 profit. So selling a cover calls win again. If let's say it rise until 210, okay. If let's say you only have the stock, you get to sell your shares at these prices. So you gain 1,000, but you also get the 250. So your profit is better than stock only. So selling a cover calls win. But what if the stock went 220? It just spiked parabolic at the expiration. Your stock only will be 2,000, having a 2,000 profit. And for cover call, because you are obligated to sell at 210, so your profit is capped. In this case, the stock will be win. So this is why I tell you guys, you have to be very clear about your objective. Okay, if let's say you expecting an exponentially breakout, okay, then don't do a cover call because you can make more than what you have actually. Uh, 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 your opportunity cost is very high. Basically, you can make more than what your cover call will be making. Okay, this is why if you're expecting a parabolic, then don't do a cover call unless that you are not sure, but you are okay to sell at 210 no matter how. Then you are good to go. You are good to go. Okay, you don't mind to sell at 210. You are good to go. Okay, you must have this kind of a psychological level. Okay, if let's say it spike up, I don't care. I'm happy. My plan work out. I'm doing the right things. Okay, so how is the whole process works? Okay, say for example, it's like initially you bought at $200 and then you sell a call and then 250. Eventually the stock ends at 205. The call expired. So what you're making now? The stock actually trading at 205, right? So I'm making $500 profit for the stock. Unrealized, this one is unrealized. But my option expired already, so I collect 250. So my net total profit will be 750. But the next month, the price dropped to 195. My stock will be what? My stock will be losing the money. So I'm losing $500. My options expire worthless, right? Because like my price didn't hit above 250. This time I sell 215 call. Okay, because I adjusted. I think still can rise above. I sell 215 call. The price went down. I collect during the times the premium is $200. I collect another what? $200. So together with 250 plus 200, 450. But my stock is still holding. I'm still losing 500. So in net, the month two, I losing $50. The month three, I expire already. I sell another cost like $205. I think I'm okay to sell at 205. My thesis or maybe my resistance changed already. I want to sell at 205. I'm collecting like $250. Eventually, the stock recover back to 198. My stock still losing money at $200. But after expirations already, it didn't rise above 205, right? So I still collecting 250. So I add on to my premium. So eventually, for even though my stock is losing already, my premium already cover a lot. So I'm net total, I'm making $500. The fourth month, I sell another 205. My resistance still valid. So the stock price eventually went up to 206. So what I do? My obligation to sell my shares at 205. So my profit will be from stock will be 500, but I'll also collect the premium. So total premium 900. So my net final will be 1,400. So this is basically how a successful cover call works. Okay. So what is the risk and the rules? Okay. The biggest things is the first thing is the FOMO risk, I would say, because it's kept the upside. A lot of the biggest because if let's say the price eventually is like spike to around 650, you still sell at 610. You're watching everybody's like making a huge gain, but you're stuck with the cap profit. Sometimes your psychological can get cheap one because you're jealous of what other people could be making. But remember that that's your initial plan. This is the final result. If you know the price eventually will goes up to 650, you won't do cover call because that's your expectation. You expect it will grow slowly and go sideways. Your goal is to just sell at the strike price. Okay? You always remember your goal. You made a profit. You never regret to taking a profit. Stick with your plan. Okay? And the downside risk, okay? The premium actually just a small buffer, okay? You can see it's at 200, 100, 250, something like that, right? But the risk is that it doesn't stop the underlying from crashing, you know. The underlying can still goes down. And then you just call it a very small buffer to cover. So that don't just go in to do a cover call for the sake of the premium. The premium is just a bonus extra money for you. You only sell the high quality underlyings that you're happy to hold for long terms, not those the stock that you think it will be going up or down. It won't be going up. Fundamentally, it's very bad. Those kind of stock, and then you're just holding those stocks just for the sake of the premium. Okay, your underlying still can drop like hell, and then the capital losses can be huge than what your premium could be covered. So that don't make this kind of a mistake. Only do your own due diligence on the high quality underlying that you aim happily to own for the long terms. Okay. Another thing is that closing back the call. You buy it back. If the price goes up, you see the underlying making profit already. Your sell call haven't expired. Okay. But because your call your stock is making profit already, you close your underlying for profit, then you leave your call become from covered become naked. This is a lot of people I see that make this kind of mistake. Then eventually the stock when parabolic, your naked call can lose you a lot of money. Okay. So the fix is usually you just close both legs if let's say you are already making the profit to exit safely, or maybe you just stick with your plan, let it get assigned. Okay. Yeah, but once you open to sell, you can't sell it even the price. So how would one know the price sharing profit higher than your call? Yes, that's the problem. Nobody knows. Nobody is a fortune teller. So the strike price have to be the price that you're willing to actually sell at. Okay. For more details, Option Hunter will be actually try to address that. Okay. So this is a chapter for the 5 rules of the successful cover call. Only rent out the stock that you are happily to sell. Okay. For example, it's like if you are planning to buy the stock you hold for for the long runs until your retirement, don't do cover call, because cover call is meant to sell your share even at the end. Okay, it's meant to sell your share at the end. If you are accumulator, you are stock accumulator, don't do cover call. Okay, you only do cover call when you are happily to sell. Okay, so you need to decide your exit price first. Okay, what is your exit price? It can be your resistance, it can be your valuations. Okay, these kind of things you have to factor in. Decide your exit price. This is how we research things. You enter into a stock, you must have a thesis. Okay? And then the third thing is let the time works in your favor. Remember, the options will decay. Remember your plan. Even don't be so fluctuate. If let's say the premium is fluctuating, losses or maybe in profit. So if let's say your sell call is fluctuating in losses, basically means that your underlying is going in the right direction. So that don't, because of this fluctuation of the losses, then you just close it. Okay, stick with your plan. Okay, and then the fourth thing is like what I have mentioned, you need to accept the cap upside. Okay, a lot of people don't accept it and they just close it for the losses that hold it and the underlying. Then at the end of the day, the underlying suddenly pull back. So you lost on your sell call, you also lost on your underlying. Okay, always willing to accept your cap upside, unless that you think that eventually it will went parabolic. That's a different story. You're able to actually buy to close your sell call to take the losses. Then you're allowing your stock to go parabolic. If let's say your thesis work out in your directions, okay. And then the fifth thing, you need to think like a landlord, not a traders, okay? Not like in and out, okay? You just want to collect the premium as a bonus, no speculation, consistency, patient, and repeatable process, okay? All right. So Just now, a lot of people's like asking like, let me see the comment section. Yeah, Option Hunter is trying to like address those kind of questions already. Yeah, Elwin is helping me, right? So like, if let's say you guys want to actually match do the cover call, there are few ways for you to actually conduct this kind of the on our apps. Okay, the first scenario is that you don't have a stock. You don't have a stock. If you don't have a stock, but you are already done your due diligence on your stock already, the price it at says for example, price at your support already, you are you are you are okay with entering at these current prices, and then you already research which target price you want to exit at. So this whole flow is suitable for this kind of people. You do your diligence already. You want to get it into a stock, and then you already have an exit price. So what you do, the first thing is you search. You tap on this search. You search the underlying. Underlying that you want to trade with. That you did the research with. Okay, say for example, you did a research for the NVIDIA, then you just type NVIDIA. Okay, but before that, I need you guys to do the configuration first. Okay, remember when you get into the here, you tap on the options, make sure that, and then you see there's a setting bars here. Tap on it, make sure that your setup is like list view and straddle view, because like later on you see like why what you look at the phone and then why my setup is very different from mine, because you have to set this thing. Okay, list view and straddle view. Remember that, okay, before I going into the flow. So what you do now, you search the underlyings already, then that you want to trade with, you do your research already. So what you do, first thing first is that you tap on options, then by default, your option chain will be in expand mode. You just tap on this arrow button, it will shows all those kind of the expiration. Okay, so you pick the expiration that you want. If you are you want to be much more active, you just go for a shorter expiration. If you want to be more or the less frequent, you want to collect more premium, you just go for a longer expirations. Okay, like 28 days, 35 days, those kind of expiration. Okay, so and then the third thing is what? Okay, you once you have choose the expiration, you tap on it, and then it will expand. The whole option change will be appear. Okay, the next step will be you just tap on these single options, and then this will be pop up all those strategy that are available on our Moomoo apps. Can you see the cover stock here? You basically just tap on the cover stock. Okay, you basically just tap on the cover stock. Once you click on the cover stock already, okay, basically what the whole things will be changed. Okay, the whole premium you can see will be changed. Okay, because it's under a cover stock mode already. So what you do now, you just focus on the left side. Remember in the chapter 1 and the chapter 2, the core side is on your left side. So what you do, you find the strike price as your target prices. If you say your target prices is like now is like 188, maybe it hit my support already. My target prices is at 200. So I just find my target prices at 200. So what I do now, I tap on here. So this dialog will be appear. So what happens now is that if I tap here, my dialog will be showing up. I will have a buy order here. Okay. So what does it tell? This order, it will be buy 100 shares of the NVIDIA. Also selling the $200 call together. It will just help me to place the order together, buy the 100 shares of the underlyings, also help me to sell a call together. So I can pull up or maybe just tap on this arrow. I can see the P&L graph. Okay, by the expiration, how much I'll be making. If let's say if price went up, the current P&L, how much I'll be making. What is the max profit I will be making? Okay, And then also we have the max loss because like the stock price also can go down, right? Remember the risk and the rules. Even though the stock price can be going down as well. The max loss will be 18,417. Why? Because like the max stock price can go is what? Zero. Then why is not like 188? Because I collected the premium also. Okay. So I click trade, then you will be seeing Nvidia like Nvidia cover stock. Okay. Nvidia cover stock. So you need to check again your order. You are buying 100 shares of Nvidia at this bid and ask. Okay. You are selling your Nvidia call at this bid and ask. Okay. So you scroll down, you also can decide whether you want to fill at what price. You can set the prices that you want. And then you also can like just enter like based on the current limit price or the mid price. If you want the between the bid and ask. Okay. Between the bid and ask, you just click on the mid price. Okay. So once you have clicked on the mid price or maybe the market prices, then you just click buy. That's it. That's it. Okay. If you don't have the stock, if you are prepared to buy the stock together with the cover call, you have an exit price, you just do this kind of thing, buy. You just do buy. But if you already own the stock in your portfolio, okay, you already own 100 shares in your portfolio, then it will be a very different approach. Basically, you just open up the option chain, make sure that you switch back to single options. Okay, make sure you switch back to single options. And then your target price, maybe you bought Nvidia at $150 before. Okay. Now you prepare to sell already. I'm willing to sell at $200. So you can actually tap on this strike price as well on the left side. It will pop out the Nvidia options. Okay. Because you are choosing single option, it will only appear the options. You need to make sure that you tap switch from buy into sell. Switch from buy into sell. So once you have these things already confirmed, then you just swipe out. You can see the P&L. What is the max profit you can making from this call? It's $287.50. I think it's like the mid price of this bid and ask. So basically, you just click trade, okay, and then you can set the price same as before. You just select the price that you want to fill at, like market prices or mid prices. And then you, in this case, because you already have 100 shares of the underlyings in your portfolio, okay? Remember, you already have 100 shares of the Nvidia in your portfolio. Then you only do this kind of strategy. Then in this case, you just tap on sell. So it's not like the previous one, because in this case you click buy because why? Because you don't have the stock. You're okay to enter together with the stock. But if you already have the stock, then you just tap on sell. Then it will automatically become a covered call. Okay? In your portfolio, immediately it will recognize as a covered call. Okay? And if let's say you want to do some custom things, okay, you don't want to actually like do those kind of the like do the cover call. You don't want to do this kind of a setup. Okay, this kind of setup. You also can do custom. You can actually click on the bottom parts here. You click on custom. You just find the same. You just find your target prices. You tap on it. You make it become sell. There's a one button here. You just add stock. You immediately shows you buy 100 shares of the Nvidia. You just sell a 200 call. It's the same thing. It's the same thing. So you just press trade and then you just press. Make sure you are buy in this case because you don't have stock. You want to buy a stock in this case. Okay. Another thing is that I want to introduce you guys one of the functions that we have is the option seller dashboard. Okay, for those who don't want to go through this kind of the option chain, you actually can use our option seller dashboard. So how it works, basically in your front page, you just tap on markets, you go to option, you scroll down and you'll find seller dashboard. Once you've found the seller dashboard already, then you just go in. You just tap on this button, okay, this arrow button. So it will lead you into seller dashboard. So what you do now is that there will be two options. One is cash secure put and cover call. Because we in today's sections we want to do only what? Cover calls, right? So we tap on cover call. So it will shows what? It will shows all the available preset options for you to choose. Okay. So what we do now, but we only want to trade the stock that we want to trade, right? What we only need to do is that we click on the filter on the right side. It will pop up this thing. Once it pop up already, and then you can just see the option filter. Okay, you just click on option filter. Then within you can choose the underlying prices. Okay, and then the underlying prices is like 100 to, say for example, the stock that you want to trade is like maybe it's within $100 and $150. Okay, and then it's already in your watch list. So you just tap on the watch list, and then you just set your underlying prices from $100 and to $150. Okay, but if let's say you want to go for option filter, you can do that as well lah. Okay, you ignore what I just said. You just stick with the stock filter. Stick with the stock filter. Sorry, stick with the stock filter, and then you just place in the underlying price that you want to trade with. Once you have that clear already, it will appear. So during the times when my watch list only have one stock that match the range to $100 to $150 is the Pepsi. So I can see those kind of setup, you know. These are the setup. What is my expected ROI if let's say I do the cover call? Okay, you can see all this kind of a setup in one shot. And then you also can sort. Okay, you just tap on this arrow. You can sort. You want to analyze how ROI from high to low to sort for you, or maybe you just want a ROI from high to low. You can set it up. Okay, once you set it up already, it will shows you here all those kind of options. So once you have these options already, you think that, okay, maybe I'm okay to sell my target price. I'm okay to sell at 147. My ROI should be around for the premium ROI around 3.4%. I just tap on it. You can see here there will be a dialog pop out. I will be buying 100 shares of Pepsi and selling another call at 147. Okay, it will just appear. And then it will also shows me all these kind of details, the day to expiration, how much premium I will be collecting, and the stock price over the strike price, and how much my buying power will be locked up. And it will also tell me like at the option expiration, if the stock price is below 147, I receive how much of the premium. Then my ROI is how much? 3.4%. If let's say it's above, then how much is my ROI? It will tell me as well. If you scroll down further, it will show you the P&L analysis as well. If let's say you're okay with this setup, you just press trade, and then you just make sure everything is aligned, just like what I taught you from the option chain. You just buy, set your bid price, just click buy. That's it. Okay. So that's the whole section. Like if let's say I know it's a bit too much, but you're having a different ways to actually conduct this kind of thing. This is why like our Moomoo is very flexible. It's like you want to go for the option the seller dashboard, you want to go to custom, you want to like go with the option chain. It's entirely up to you. I'm only showing you there are various ways for you to conduct the cover call at a very easy way. Okay, so here, so this the whole chapter, that the first chapter of the phase 2. Okay, the cover call, the income first, the phase 2 income first sections, the cover call. So that's the whole chapter, no? So remember, you guys follow this one. If let's say you guys want more about the a chapter like this, what to consider, what is the things you need to be considered. This is and then today we just wrap up the cover call, the phase 2 of the chapter 1. Where to watch the phase 1? You can go to the option playbook pages. You just scan this one. You just follow our pages, and then there will be a button for you to click on live. You just click the live, and then you can see the historical record. Okay. How is the Moomoo? Today we only covers the Moomoo mobile section. In the Moomoo desktop, I think maybe another Tuesday, another Alvin like Option Hunter will be covering up. I hope we can cover this as well. Okay. Where to find the seller dashboard? Okay. Where to find the seller dashboard? Basically, you just in your front page, you just go to markets, you tap and then there's a you can see a lot of tabs, right? Then you just find options. You find the options already, you just scroll down. You just scroll down from here. You scroll down already, then you find seller dashboard. You tap on this arrow, then you'll see the dashboard here appear. Okay? You'll see it appears. Okay? Is the 4 months row something tried and tested? It's a historical data, I would say. Yeah, it's a historical data. But some of the premium is hypothetically, but you actually can find because you can see it's like just now you are showing those kind of examples like the premium you can get like 285, 290. I'll just wrap it. I just round it up like 250 for easy understanding. You can see it's like if let's say your target is like 250 expiration, you can get roughly this kind of the premium. Okay. How if I have 200 shares of yes, it's possible. If you already have 200 shares of the Nvidia, you just want to do one cover call. Yes, you just sell one contract. Okay, you own the stock already. You just sell one contract. You don't do two contracts. Okay, you don't do two contracts. You just sell one contract. So you will be having 100 shares of the Nvidia long stock and another cover call. You just do one contract and you just press sell. Okay, so we'll be having one cover call and one another remaining 100 shares will be just your stock. Okay, you can do that. Okay. So yeah, I hope you guys enjoy the whole sections. Okay, you know, like if let's say you guys are good happy with the whole chapter, please type 1. Let me know you guys actually understand or maybe like enjoy the whole sections this cover call. Yeah. Or maybe you guys still need some time to digest. Okay. If let's say okay, let's do this. Like if you guys enjoy the whole session, please type 1. If let's say you guys still like confused, need a rewatch, then type 2. Okay. I saw some of the questions that asked is quite like rolling those kind of things. I think Option Hunter is already addressed your questions. Okay. Okay. Oh, okay. Thank you. I saw a lot of 1 already. Thank you. Okay. 1 and 2. Yes, you can watch the replay as well. Don't worry. Okay. Once the sessions are done, then there will be like maybe a few hours of the for the back end system to record down. Then you can watch it. Watch the replay on the option playbook. Okay. Make sure you follow options playbook because like in the future I will be covering the income phase, the 2 more strategy income phase, or maybe you want to make income from only spread, those kind of things. It will all be covering in the option playbook. Please make sure that you scan the barcode and follow us and stay tuned. Turn on the notification as well so that you don't miss out whenever we having live. Okay. And I also have just a very quick hold on a second. So that when you scan already, right, just a very quick one so that you can actually like go to here. You can see it's like there's some of the sessions here is open for you to actually book it already. So make sure you book it if you want to get to know more strategies like this kind of real strategies and this kind of the get incomes. This is today's sections. You're also like turning patients into income, cash secure puts, if let's say you want to get to know more about this income strategy, make sure you click the book buttons here. Okay. If you guys want to book all the sections, I also have this option playbook series post here, the phase 2. You just click on it and then you just see the link here. You can book every section. So today we just wrap up the cover call. We have 2 more sections to come for the income phase. Once we have done the income phase, we're getting into those spread things, okay? The trading parts of it, okay? So make sure you follow option playbook, okay? And turn on the notifications ring, okay? And then also stay tuned for the Tuesday sessions. The LB will be conducting those kind of the amazing backtest strategies. Okay. What's coming up next? Next one will be cash secure pool. Okay, stay tuned. You just book it in the option playbook. Okay. So I hope you guys do enjoy. The market open already. I bet you guys want to like monitor the market more than monitor my pages. So hope you guys have a good night. You know, like happy hunting. Yeah. Okay. Happy trading. Happy hunting. All right. Right. So I'll be at my live session. Thank you guys. Thank you for your time. Happy hunting. And then may the profit be with you. Okay? Right. Stay profitable. Bye bye.